Good afternoon, everyone, and welcome. Thank you for joining us today's discussion on GST governance for fintechs and payment boards. My name is Krishnan Arora, partner and leader India Investment Advisory and Indirect Tax at Thornton Bharat. I'm happy to be hosting this session as your moderator. As we draw close to the financial year 25-26, I cannot help but reflect on the dramatic shift in the environment, tone, and the tenor of the regulatory supervision in our country. In many ways, it's clearer how multiple acts and regulations work in tandem to ensure there is only one straightforward way to do business. In many ways, I also see many complexities in implementing regulatory compliance frameworks and systems to adhere to regulations in this fast evolving digital native world. Regulatory supervision enforcement, for that matter, has become stricter and more decisive and can result in severe adverse actions, creating personal risks for senior level executives, including boards and independent directors. Inquiries and monitoring by regulators has also taken the investigative color using information that can be queried with sophisticated tools and technology by regulators and the law enforcement agencies themselves. This is the big change from the earlier inquiry and audit driven nature of monitoring. What were earlier viewed as routine tax and compliance issues are now being examined through a much sharper enforcement lens. Investigations that began as GST inquiries are increasingly intersecting with broader questions of operational governance, systems integrity, and accountability at the senior management level. From a GST standpoint, the risk is no longer confined to tax computation or return filing as well. It now extends across entire operating and transaction chain, from payout structures, commission models to partner and business corresponding arrangements to how data flows through systems and is reconciled. And GST often becomes an entry point for regulators to access data, test the governance, and then assess the intent as well. And this is precisely why GST governance cannot sit in silos anymore. It must be viewed alongside the operational risks, the regulatory overlaps, and the enterprise-wide controls, especially in the fintech sector, especially with payment models where scale, speed, and multiple party transactions are core to the business. So today's webinar is not just about debating whether the authorities have the powers to do any such act. The law is pretty clear in terms of what they do. Instead, our focus is on a far more practical and broader level assessment in terms of the question, how do fintechs and payment businesses adhere to complex cross-regulatory requirements and protect themselves from situations in which compliance or systems gap can actually escalate into coercive regulatory actions. And to explore this holistically, we structured today's conversation as a panel discussion, bringing together perspectives that reflect how these risks manifest in the real world. Joining me today are a panel of experts specializing across various facets of the fintech business, risk and regulatory. And I'm happy to introduce my colleagues here. Rohan Lakyat, who will bring in an operational and system lens to how transactions flow through multiple systems, merchant KYB, partner dependencies, data gaps can unintentionally create GST and other regulatory exposures in the fintech ecosystems. I also have my colleague and GST expert Biren Vyas, who will share insights on the GST governance and compliance frameworks, focusing on how organizations can proactively structure controls, reconciliations, and documentation to reduce the downstream risks. And finally, Vishal Narula, who will help us frame why GST governance has become a broad board level issue, particularly in the context of enforcement of trends and how investigations tend to evolve once initiated. And before we begin the panel and I jump into bringing each of my experts in, for your ease, we've activated the Q&A box as well on your screens for you to put up any questions for the panel in case the same is not addressed through the discussions. Well, if it does, great. Otherwise, at the end of the session, we have kept some time for the Q&A and I'll pick up those questions and ask our experts to kind of respond to the same to the best of their abilities. So to start with, Rohan, let me put you in the spot. How complex it can be for a fintech to set up business models that are competitive at the same time financially attractive to its business partners?
Yeah, thanks, Kishan. Good afternoon, everyone. Kishan, let's take a step back and understand how the fintech ecosystem has evolved over the years, right? Fintechs, I think the revolution in fintech started about 12 to 15 years ago when fintech started entering into the payments domain, which has got the least amount of entry barriers. And over a period of time, they have ventured into capital markets, insurance, credit, lending, even neo banking activities. But the transition point for fintech came about in, I think, 2016 when Demon happened. And that was the first trigger that really put the pedal on the floor to demonstrate to the fintechs that to the audience or the customers and the investors that fintechs could potentially change the financial services landscape for the country. And then, of course, with the COVID coming in, everything was happening remote, online, digital. Fintechs really took off from there on, and the investments in the fintech ecosystem, I think, peaked in 21, 22. And subsequently, it also it also raised RBI's scrutiny levels at fintech because the scale at which they were operating. They were serving large number of customers. They were largely not directly regulated by the RBI or the other regulators, sectoral regulators, but were partnering with the incumbent financial services manufacturers, so to say, to deliver financial services. And from then on, when the regulatory scrutiny heightened, there were certain regulatory instructions that came about which disrupted a lot of fintechs business model. And that's when the going became tough for the fintechs from there on. So 2022 to 2026 has been a different story altogether. While, as I said, the entry barriers for fintech can be pretty low because not all of them get regulated or licensed by the regulator. They partner with incumbents and therefore they're able to cater to large number of customers. And typically, if you look at it, they are part of the delivery channel largely. Some of them, of course, have regulatory licenses, but most are acting upon as a delivery layer for financial services to serve customers digitally. So from that standpoint, the entry levels it's easy to get into a fintech business, but given that it is a highly regulated sector, it has become increasingly difficult to scale without having proper checks and balances and risk management practices embedded in your product design and your business life cycle. So from that standpoint, even as they scaled, there was a lot of optimism around monetization opportunities that will come about, and therefore fintechs will be able to scale meaningfully while making reasonable revenues and profitability, but that is still yet to come. The revolution is still, I mean, evolution is still ongoing because these guys are new kids on the block. Their business models are evolving, but over time, to scale profitably has been a challenge that has been seen recently. And a lot of these fintechs have evolved their business models and changed to focus on rather than vanity metrics such as scale, number of customers served, to more basic building blocks of the business, which is revenue, cost of customer acquisition, profitability, etc. So, given that they are still evolving, it has been a challenging sort of couple of years for the fintechs and with business partners as they align. Even some of the fintechs are facing significant constraints around funding as well. But things are sort of taking shape as they discover their foothold in the financial services landscape. And therefore, the monetization opportunities are now coming to the fore. So that's where we are at. I think the next 3 to 5 years will be the defining moment as I see for the fintechs as they scale meaningfully.
So, Rohan, I think what you from what you said and what we know is that the space has been relatively evolving, and how things have been looked at from a regulatory lens has been probably not the first focus with when the fintech started working, and how they have kind of had to re-strategize their business models and how they've evolved from there. But coming back from the perspective of risk, from that perspective, I think from an operations perspective, it seems that the businesses do involve multiple stakeholders and often operating on different technology stacks. Does this create inherent risks for the business?
Absolutely. And as I said, that maybe you can divide fintechs into two sort of large buckets. One is the fintechs which are regulated directly, and therefore they are owning the customer life cycle end to end, and therefore they have full life line of sight across the financial services value chain. But the larger bucket is that of fintechs which are acting as a delivery layer for financial services by partnering with manufacturers of financial services. So they interface with the customers, but the backend is powered by incumbent licensed regulated entities. And given that because of their nature of services, they have to interact with multiple systems, multiple stakeholders, which includes, say, merchants in payments. There is a network which processes the payment. There is an acquiring bank. There is a settlement bank. There is a issuing bank. So all these systems, all these stakeholders also operate at with different systems, and therefore the integration amongst those systems can be a challenge. And as you work with multiple stakeholders, operational risks also compounds to that extent. Therefore, risks from a technology standpoint, because they are tech first, is certainly significant. Any challenges with respect to the way they have integrated across the financial services value chain could create a problem across the financial services ecosystem. They are, of course, they work with third-party system providers such as fraud analytics services or regtechs, which provide KYC services. These are again inherently they have to monitor their performance, etc., and therefore it's a risk that they need to manage well. Then there is, of course, a merchant and customers, right? The way they are onboarded, the kind of due diligence you apply has to be robust because given RBI's focus on customer protection, the heightened frauds that we see in the digital ecosystem has to be addressed because fintechs play a key role of facilitating these services, and therefore, because they are in the value chain, not just the sectoral regulator like RBI, even other regulators or agencies look at fintech operations very, very closely. And therefore, managing these risks is key because they are now ecosystem player and not just an institution in themselves because it has a cascading effect across the ecosystem. So therefore, a strong operational control has to be demonstrated by the fintechs when they operate at this level and when they're partnering with incumbents and manufacturer of financial services and catering to the customers.
Right. And I think when you talk about risks, I think the spread of the risks is so wide because of the whole ecosystem in which the fintech industry works. GST is just, kind of, is one of the examples where, the investigations, the way, things have evolved from the time GST came, more and more transparency of the system, more and more transparency in terms of self-assessment has brought in a lot of, adherence and stricter mechanisms to actually comply with. And that's been one of the key examples how we've seen, investigations panning out across various sectors, including fintech. Plus, also the fact that data mismatches had been such a big issue to be dealt with initially. I think people thought that the compliance was basically one of the only requirements where, data can kind of, some of that can be done on our own and other things can happen as we kind of get assessed later. But I think that was not the intent of the government, and that's why the risks and the complexities from the perspective have actually widened so much that it has become a larger risk from that perspective. And that's why, wherein by you have been dealing with clients and on the subject of GST as well. We've seen how things have changed and evolved in terms of tech automation with the business's expectation, the data volume which a fintech industry really grapples with. What do you think are the key complexities in the business environment? As taking cue from what Rohan mentioned about the overall, risk in the framework, what could be the GST perspective risks or complexities which you see have been experienced by the industry?
Perfect. Thanks. First of all, thanks, Ishan, particularly picking up GST perspective. A question while Rohan has highlighted that it's fairly and highly regulated business. GST is one of the key challenge that goes without saying, particularly for the fintech, and why that I'll highlight. Overall, GST when it has been introduced in 2017, the entire compliance approach should have been, I assume, that should have been changed by the entities, and probably if it not, then it's now time to look at it. Certainly, because the expectation is fairly high, particularly the way the return formats and expectation, particularly annual compliances, are introduced. As I see today, the GST returns are no longer reflect just the tax numbers as it was earlier. They reflect the quality of business numbers and the strength of governance behind the business. See, from GST perspective, such complex business environment, particularly where multi-layered operating model, as Rohan has explained, involve or rather it demands a sharp and holistic evaluation of the entire arrangement. The key complexity lies in correctly identifying and characterizing the nature of each approach, each transaction, each business leg, not just in theory, but as it is actually implemented on the ground as well. This requires a critical assessment of contractual flow, commercial substance, and the operational execution, and ensuring that these are consistently reflected in supporting documentation as well. Because at many instances, the success of entire position, plan, and process highly depend upon the documentation which is maintained behind it to substantiate the stand which is taken. Any misalignment between intent, documentation, and implementation can significantly increase the GST risk. Even where the intended GST position is technically sound and correct, the inconsistency between key documents can undermine the position. I mean, is something which one need to keep in mind. Therefore, it becomes imperative that to clearly define the exact nature of the proposed transaction upfront. First, plan out, take position, and define the proposed transaction very well upfront, supported by the robust documentation, particularly in this kind of multimodal and multi-layered business scenarios, to ensure that the GST position is sustainable and withstand scrutiny as well. Say, for instance, where one entity contracts with other customer, or probably other entity performs like underlying activities such as customer onboarding, payment processing, or compliance support, the GST authority may look at it from different lens or different angle, like who is the actual supplier for the GST purpose, whether the nature of consideration retained is commission, service fee, or a part of value of the main supplier, or what exactly is the nature of revenue which is generated. Who is generating revenue at what point of time? What is the time and supply of generating the revenue? Whether the entity earning a margin is acting as an agent or independent taxable service provider. These are some fundamental questions which authority will first look at it when they will do the desk review. Uh, Key point is, while looking at all this, that the documentation and implementation risk is critical GST exposure area, even where the intended GST position is technically sound. So as to, if one need to look at implementing the robust GST governance or framework, particularly for the business model, business complexities that Rohan, my colleague Rohan, has explained, one need to keep 5 points very well in mind. That first, need to have immense clarity on the business model, particularly transaction, each leg of transaction from macro to micro. Then plan a position properly. And the once it's planned properly, do reflect clearly, identify and reflect in the agreements and the contracts or PO which are executed with different stakeholders. For well aligned with the arrangements which are agreed with respective stakeholders. Give the right, suitable, and correct accounting treatment as per the accounting standard in the books of accounts, so that it's very well aligned with the books of accounts as well, and the actual operational conducts which match well with entire approach. And this probably will help business to mitigate the risk particularly. And IDT function probably will be no longer only a compliance transaction, but from impacting the business perspective, it is more a data-led regulatory lens, which needs to which needs to be looked at it from start to end in a complete in a complete approach, and then implement accordingly. So that's overall. There are a few critical areas probably which I would like to highlight maybe at a later stage. But just the last one point which I would like to explain, that while answering your question, that GST risk goes well now beyond tax rate and classification. It touches variety, like revenue structure, partner and business correspondent models, settlement and payout mechanics, system driven reconciliation and data integrity. Largely, each layer introduces tax, regulatory, and reputational exposure, which needs to be planned and implemented properly. Is the key point which one need to keep in mind.
So thanks, Biren bhai. I think greatly elaborated in terms of the wide span of actually areas which GST covers, and it's just not about compliance. It's just not about how you are presenting your data, but also backing the data with the right documentation and presenting it in the right manner to the world is become a very important area which kind of fintech businesses with the way they are dealing with various stakeholders becomes very critical. And I think from that brings me a point which where I'd like to bring Vishal in. Vishal, you've seen that the GST investigations have been on the rise. Overall regulatory framework also has now led to a lot of, questioning by the authorities on various fronts, but GST being one of the access points where, Biren Bhai and Rohan talked about certain specific areas which tend to really, become, where you can kind of see there could be slips or there could be certain intentions which are not completely backed by the right documentation. But coming from the perspective of how this is becoming a larger, risk actually, to say what, how can regulatory and system issues possibly result in a strong and adverse action by regulators and the law enforcement agencies?
And it's not an easy answer on how it just translates into a larger, broader level issue.
Right.
And I believe that in several ways, I mean, all three of you have kind of touched upon it in different manners. The first thing, I think the question that you mentioned was, multiple laws are probably working together to make sure there's just one straightforward way of doing business. I think that really has come out as a large intent over the last decade or so. And now we see how those things are really working together. In several training sessions that we do for law enforcement agencies and regulators on investigations and methodologies for investigations, it is sometimes surprising to know subtly when they ask us questions to the level of data that they have. And the fact that the interpolation, of data or the cross-pollination of data, and the fact that if it does not talk to each other, it cannot just be a mere coincidence or a mere system issue, and how they've understood how to filter out issues which could be systemic, industry-oriented, and bring out those which may have intents that are not the best from whatever point of view, whether it is from the point of view of having lower tax outflows or bad tax planning, whether it is for consumer protection, or simply for other reasons, from the point of view of money being exchanged on online platforms in different ways, investments in, investments out, etc., etc. We see live that these kind of issues and the so-called red word that we use as consultants are red flags. The so-called red flags that we see are actual real indicators of issues that regulators and law enforcement agencies know that they cannot ignore anymore, right? And why? It's because now our systems have started in reality working together across different regulations with agencies coordinating like never before to be able to have that single entry point in an organization where they know that there is a reasonable, strong issue that they can rely on in terms of an investigation on an inquiry, and they know that more often than not is going to be a positive red flags rather than a false positive red flag, so as to say. Now, all of this boils down to what? It doesn't just boil down to different provisions of a particular regulation. It boils down to the way business is carried out, which is why governance is more important now, and governance is a board level topic. So the boards, and irrespective of whether they are LLPs or private limited companies or listed companies, boards have to now genuinely execute their fiduciary responsibility towards internal and external stakeholders to make sure that the organization is carrying out in a business that does comply with the law of the land, which is why the complexity levels are becoming even higher. And like Rohan also explained about, different complexities in business models and systems and so on and so forth. All of this, I think, is only going to become a lot more integrated in future. GST is just one example of it, where you have an entire value chain on the same platform. And therefore, you just should not have, you can, of course, but you should not have mismatches that are just, outside of an explainable kind of a domain. So the governing bodies, which is basically the boards, have that responsibility to make sure that systems, processes, controls, people, and technology, all of that is structured in a way that ensures that the organization's risk, enterprise-wide risk, is mitigated to the maximum possible extent. And even if there is any redundant risk that is left, is only a function of say an ambiguity or a genuine limitation from the point of view of systems. And if that is really in place, see how that pans out in a regulatory action. Okay, you will be able to demonstrate to regulators from your documented processes, documented policies, existing systems, historical data that would be available in systems, minimal manual interventions, minimal manual documentation, that intent is clean. And the one single fine line between coercive and non-coercive action, is intent. If an authority enters a particular premises, and we know across different regulations, whether it's related to money laundering or income tax, or whether it's related to GST or anything else whatsoever, it is the intent that becomes the deciding factor on whether the action of the regulatory supervision that regulators have taken must be in the nature of a corporate action, or it needs to go beyond that and turn into a coercive action with a far higher personal risk. Which is why, if you see now in listed companies, especially with boards and independent directors, they are particularly conscious of the responsibility, because they know that there is a real sword or a threat of personal liability that does exist if they are not able to demonstrate that they genuinely carried out their fiduciary responsibilities towards internal and external stakeholders in a really good way. And that is exactly why now it has become all the more a board level issue, right?
Yeah.
I can tell you from experience, and way back in time, I can tell you at least, I think a little over a decade ago, we had a very large international kind of a regulatory action happening on a subsidiary of an international company here. And that kind of today has become a textbook case study to say that when you are able to demonstrate governance structures, you might be able to get away with a punishment as heavy as having a monitor on you. Okay, which I think is far better than any other capital punishment that any senior executive can face or should be facing in a scenario where you have extremely complex business environments, extremely interdependent, touching businesses that are inherently high risk from the point of view of, say, money laundering risks and so on and so forth, right? And naturally creating ambiguity about what kind of business structures, and irrespective of the stand you take from a law point of view, right? And which is where, as businesses evolve, and if the law does not keep pace, you can take a stand to say whether you are providing a service, whether you are an agent, and etc., and what should be your entity, and how you should be looked at from a taxation perspective. All of that then eventually boils down to the intent and how you really governed it. And if you're able to demonstrate that you really governed it in the way that you're saying is your intent, then, like they say, the jargon, the rubber meets the road over there, and that kind of becomes the real test. So, entry point here, Christian, that word that you use also extremely important. The cross pollination of data generally creates entry points, and we see that very often because the business, any business cannot just focus on one regulation in isolation. An entry point naturally becomes a way that if you have an issue vis-a-vis one regulation, you inevitably have consequential issues on other regulations. And that kind of holistic lens from a business model perspective definitely makes it a board level conversation, which I think now needs to be looked at. Like boards need to look at businesses in a zoomed out way and also from a granular level at the same time. And so yeah, so it's become a really tough job to be a board member today.
No, well covered, Vishal. In fact, I completely agree with you. I think the steps which are today taken by any regulator is not just dependent upon what they find in their compliance documentation, which is submitted to them. It's actually all the acquired information and the data analytics, which are so powerfully being used and exchanged between different bodies within the government that you cannot now afford to have a representation of a data which is having no back, which is not matching with the data which is going to the other side, being presented in another forum from that perspective. And what you really also represent there in terms of how you are putting up any facts and cases as part of the assessments, etc. All of them have the same impact in terms of the way the data presentation is actually put up before any other officer who's not sitting in front of you, but knowing what you're doing actually. So from that perspective, I think, and we know, Biren Bhai, the fact that in GST as well, they are very clearly able to track 7 or 8 levels backwards to every transaction to track who's involved in that chain, what does that transaction entail, how did it become a supply, where did it get taxed, where did it not get taxed. All of that data is being exchanged at a much wider level. So I can't agree with you more. The fact that how important this matter has become for the boards in terms of how anything which comes as a red flag can actually have the board members or the management be accountable for every bit which has been done, even if it's a basic compliance or a return filing or a data which is presented. So from that perspective, I think Biren Bhai, we've seen investigations, and the reason why we all are talking together in this session is the fact that this is just not a GST risk today, but from the perspective of at least we witnessing how investigations have panned out and what do authorities really look at. Can you help our audience understand the framework that fintechs need to apply so that they can navigate the complexity and at the same time mitigate the risks of an aggravated action by the regulators and the law enforcement agencies?
Perfect. No, Vishal, first of all, thanks. This was really helpful because overall, what you have highlighted, if I look at it from the GST angle, in summary, it needs a substantial shift in the mindset from the accuracy in compliance to the robust governance, and which is a nothing but an entry point for our regulators to test the governance, control, and the intent as well. And probably if at all there are if at all there are some disconnect, probably or certain situation, it might get escalated to the serious regulatory action. So it needs to be addressed upstream and not post facto. I'll continue from there, and I'll just try to highlight from macro to micro. I'll prefer to sound not too technical, but still, if I look at it, entire overall approach, particularly for the fintech, which is a fairly come with a complexity and a GST framework, which needs now far more structured and defensible framework that combines the transaction level clarity that require the transaction level clarity with a strong governance. See, any net off which was observed in certain cases, and I would like to share experience, of course, that any nut off or misalignment here can trigger the GST perspective challenges like dispute. Classification is too generic to highlight, but valuation and short payment of taxes, and particularly in certain cases like deferment of taxes and timing of payment of taxes as well, which leads to challenges for the entity. The commercial construct should mirror the tax position and support clear contractual terms and accounting treatment, which I've highlighted earlier. So at a broader level, the fintech need to institutionalize a robust compliance function and build on a five pillars. Those five pillars, which one need or more than the fintech, any sector which has a complex model can keep this in mind. First is well-reasoned tax position, probably which needs a clarity. That's first. Second is the alignment of accounting treatment with the tax position. Third one is the clearly defined the processes, which includes the maker and checker concept as well, so that there are no surprise at a later stage. Thereafter, risk and control metrics which are very well embedded in the process, so that if at all there are some announcement or some key challenges for exceptional transaction during the business, it is taken care of at the right point of time, rather than the authority highlights and probably preparedness at that point of time. Any contemporaneous documentation or discipline in the compliance execution, probably it needs to be handled basis all this, probably for ongoing preparedness for regulatory scrutiny. Post, if at all there is any, because the post return filing, if this approach is followed, then the preparedness will be such that any question, any clarification, any point where which needs a which is inquiry from the authority can be addressed in a much stronger way, and it reduce the interpretational risk and demonstrate the bona fide conduct as well, thereby mitigating the likelihood of aggressive action. And GST return, if we look at it, it's beyond a tick in the box now, as I've highlighted earlier, because it travels far more than probably tick in the box. It's a overall, because your entire first, if I look at it first, barring or rather except your few financial transactions, and every all entire revenue is reflected in the return. All the procurements, be it a goods or expense or a services, it will be reflected in the return. So almost every business transaction is reflected in the return, and it will be taxable on one hand and creditable on another hand, subject to reversal, which are already provided under Rule 42, 43, and some of the other clauses, some of the other sections as well, rules as well. When it gets reported in the strongly in the return, probably it reduces the risk. So if we look at it, GST snapshot, which are particularly for the fintech payments and fintech and payment business, there are 5 to 6 areas. Of course, we'll try to cover this in the flyer also, probably, which we might circular post this. All it covers 5 to 6 areas. The inadequacy in the documentation, if at all, if it is there, then the definition of commercial substance could trigger the GST demand. So it needs to be very well handled. Second, three-way reconciliation. Three-way reconciliation, what I mean is the GSTR 1 versus 3B. Slightly technical, but please try to understand it's a reconciliation between GSTR 1, 3B, and books. All three, probably, if it is handled properly. In short, credit ledger vis-a-vis what is reflected in the return and what is reflected in the books, it needs to be very well reconciled. Cross-border payment fees, places where whether IGST treatment is properly or consistently applied or not, and particularly with regard to export or probably with regard to import, it's rightly considered or not. GST on the payouts, commission income, probably in some certain cases, in certain cases, the way contracts, the way arrangements are defined or treated to treat the same as an exempted financial service, you know, in certain cases, which which probably needs a more clarity and which needs to be handled more carefully, particularly and highlight each leg. ITC and the various procurements like technology and marketing costs, probably how treatment of again rule 43, 42 and 43 analysis, particularly with regard to input tax credit, how it is considered, computed, and ITC positions should not be highly vulnerable to reversals. And what how it is treated is moot question which one need to look at it. How the business correspondence or partner commission, particularly with regard to GST treatments, are considered and documented and accordingly reflected probably as a revenue in the return as well. Float income or nodal account, how the interest is treated and probably how it is reflected well in the documentation. API and platform access fees, how it has been treated and accordingly reflected well in the documentation and accordingly in the compliances. All these kind of Christian, as Vishal has highlighted, Rohan has highlighted, all these kind of each leg of transactions are identified properly and reflected well in the documentation and accordingly in the compliances, probably will help the entities to govern the entire compliance framework very strongly. It will give the relief to the board also, which ideally should shift in mindset from the accuracy in the compliance to robust governance framework, which will help them to reduce the risk substantially at a later point of time. That's overall, which I thought probably one should keep in mind.
Right. The volumes with the industry, and I'm not just talking about fintech, payment industry from that perspective as well. With the sheer volumes of transactions which they have to undertake on a real-time basis, I think this issues which you highlighted become very critical from the perspective of even data management, from the perspective of how they are all being compiled together. Somebody is reviewing it from a maker checker perspective. Somebody actually looking at what's going and being presented is consistent with the books, etc. I think are very, very important factors. And as any small trigger from that actually results in such a large potentially issue, which Vishal you talked about, can become coercive or non-coercive, will depend on the intent. But I think factual elements have to be presented in entirety in one place consistently. I think that is something which has to be very, very critically looked at for the sector at least. And when you talked about the governance framework, per se, and just not compliance framework, I think that's a very important part, wherein by which you also talked about. And Rohan, how does it really translate into governance framework from operating systems and finally a board level oversight? Is
Yeah.
what we've heard just now. From your perspective, what do you see of that?
No, absolutely, Kishan. See, the way also Viren explained, I think it was very comprehensive. Especially he talked about, and he was referring to, of course, GST compliance, and it has to be pretty strong, and then it has to move to a governance model. What I would say, and the way we see currently the fintechs operate, and let's also acknowledge that they're fairly young in the game, is that sometimes the tone from the top is missing. Ultimately, the culture of risk management, compliance, assurance has to be driven top down. It cannot be bottoms up. So, from a governance standpoint, the board, senior leadership has to allocate and demonstrate importance to these areas, because ultimately these are the areas risk compliance assurance will give the confidence to the business to be able to scale confidently, and therefore they should be at the outset itself being considered as a strategic partner rather than an operational block that has to be navigated, which is currently that we see in some of the fintechs. And while things are moving because of regulatory nudge as well, but there is still a lot more to do. And therefore, from a governance board oversight perspective, I think the board needs to allocate that level of empowerment to the control functions for control functions to operate confidently within the ecosystem, because currently typically what happens is that the first line and I talk about risk compliance as second line, assurance function as the third line, the business function and operational functions are the first line, typically have limited appreciation or sense of the kind of risks that they're undertaking, because the conversation with the control functions are not free flowing currently, and the middle line or the second line and the third line do not have a seat at the table when products are being designed or business opportunities are being explored. So therefore, these have to be a collaborative effort. They can't work in silos. The risk management is not really a risk management ownership. It has to pervade across the organization. The second challenge that I see at least is from a fintech standpoint, the risk management, compliance, assurance functions, they do develop RCMs, work across it, but currently some of them are developed in silos. Like one particular function will have an RCM, but in a digital world, risks interact with each other and can manifest in new ways. Like for example, you design an incentive program for, say, an agents to onboard merchants. Now, incentives have a perverse way of playing out exactly the opposite way it was supposed to serve a purpose. And when your say KYC norms or transaction monitoring is weak, is not up to the mark, then bad merchants onboarded will become a threat actor within your ecosystem, and you'll not be able to respond to those threats appropriately. So the second part is that you have to also look at your risk management program not in silos function wise, but also look at it holistically from an enterprise standpoint, and also understand that there could be relative interactions and how these risks can interact, and therefore create mitigating sort of take mitigating measures around it. And the third part is that there has to be oversight by the board. Currently, sometimes we see that the assurance functions or risk functions presentations are check in the box rather than a detailed discussion that happens with the board, where they spend enough and more time to discuss the challenges that the entities facing. Currently the boards could focus more from a business standpoint rather than from a control function standpoint. So I think the third point is to have appropriate board oversight on the material that is being brought to their notice, have meaningful discussions, and this is something that is also regulator is nudging the entire ecosystem towards that, and there is enough and more sort of responsibility that is being cast on the board to see that board is also looking at it critically, questioning the management rather than accepting things as they are being presented. So these three aspects I think are going to be core, given that these were the early days. Now fintechs are supposed to act more responsibly. The conduct issues that we have seen in the past has to be addressed, and largely they're moving the right direction.
Right.
But Krishan,
Thanks.
just to add
Yeah.
one point while Rohan has covered it, I'm sure you know very well that, very soon, probably not, no, dates are not announced so far, but the GST compliance rating will be introduced, and the certain parameters are already announced, particularly to keep in mind. As and when this GST compliance rating will be introduced, probably it will help entity to gauge the risk, particularly while dealing with the multiple stakeholders that they are dealing with, whom, which kind of entity, and probably what is the compliance setting. At least it will help to some extent to reduce or probably mitigate the risk, but certainly probably still one will need very robust and strong framework, and framework, particularly to maintain, or rather to have a better compliance rating, particularly which will be publicly known.
Absolutely. I think that brings me to the question which at least I would want to ask each of you. I think one top thing which you think a board or a senior level executive and an organization should be actually looking at as a priority to mitigate. While you mentioned many of the things, I think just for the benefit of the participants, what should be that one top thing which should be done to mitigate the risk of falling into deepest of these pitfalls that can create these risks and liabilities at a personal level? Starting from you, Rohan.
Uh, well, I've touched upon it, Krishan. I think these risks, see, you're in the business of risk taking. Ultimately, there is
Yeah.
no business with zero risk. My submission to the entities is gonna be to empower these functions to work as a strategic partner, and which I've talked about earlier in the past as well, rather than look at them in an adversarial nature that they are supposed to help, not help expand the business, but will constrain the business. And that is when your ability to do business confidently will rise, and there will be minimal regulatory intervention that you see as your business scales, because ultimately you don't want surprises to come in right at a later stage when you are sitting at a particular scale, and then you have to wind down that particular business because that was not regulatorily kosher, or it was not aligning with certain regulations and acts. And so that's really, I mean, I'm cognizant of the time, so I'll leave it at that. Really empowering the control function and working with them as a strategic partner would be my recommendation to the fintech ecosystem.
Sure. Viren bhai, anything for the top management at a personal level to add to what you have already mentioned or Rohan mentioned? You're on mute. Sorry.
Sure. I'll just highlight one point probably, which is a summary of overall what I've discussed. That this conversation, entire conversation, be it from Rohan, Vishal, or myself, this conversation is not just about the GST or about the mechanics of compliance, but it's about how the compliance mirror the enterprise-wide risk and what boards and leadership teams must do to prevent the compliance gap from becoming disproportionate outcomes. That's something which needs to keep in mind. Nothing more than this.
And Vishal, I'll put the same question to you, but also if you can tell us and the audiences about what should actually, if this is what it is, what should companies actually be looking at and to do as a next step as well?
I think, Krishan, now is the time that organizations, boards, even external consultants who do help with risk management frameworks, etc., start using investigative lenses. And you're talking about personal exposure that only arrives in a situation where a regulatory action is investigative in nature. And therefore, to know whether there is any personal risk or not, an investigative lens on all sorts of exposures. I think not just from the point of view of GST, but GST combined with PMLA, combined with RBI guidelines, combined with KYB, which is know your business, KYC, and the processes and controls that have been put in place to ensure that there are enough checks and balances at transaction level. Those become really, really critical, right? Now, from a GST perspective, all of that obviously rolls back into a GST framework, from a PMLA perspective into a PMLA framework, and so on and so forth into respective frameworks. See, you can't run different processes to comply with different regulations, right? Those days are gone. You'll have one process, one set of data, and all of that needs to comply with all the relevant regulations at the same time, which is where the leadership and board, right? The executive leadership and executive non-executive board, all of that comes together to test whether there is a strong first line of defense, there is an active second line of defense, and what is the independence of the third line of defense function that does exist. And that is the assurance that rolls up to the board level. And if the board members and key management executives want to know what will be the personal liability, they need to start insisting on whatever is, say, a legal stand, a business stand, and what is an investigative lens kind of a look like. After that, it is all useful only to the extent that it translates into actual mitigation and remediation steps. So action must follow these so-called remediation recommendations that come through, whether they're from the internal teams who mitigate risk or external advisors who help in mitigating risk. And specifically today, from a GST perspective, we've put in a 4-pillar action plan. And what organizations must do over the first 2 weeks, in the next 2 weeks, say in the next 4 weeks, in a flyer, and the QR code to the flyer is right on screen. And I'd encourage all the participants to, have a look at that. It actually brings out specific critical and medium level risks that do exist from a GST perspective. But I'd just like to sum up this, and also respond, Krishan, to that question about the top thing that the boards must do today. right? And I come back to what I've been saying. If at all there is a risk of any personal exposure, or an extremely large exposure, which can go to the extent of a regulator overnight shutting down a business, which has happened. Okay. And I'm not saying too far away. I can tell
Yeah.
you it has happened in the last 4 months, that we've seen RBI issue directions to say stop right now. And that means that you've put all your employees at risk, your investments into technology, your investments into various different things, all of that come to a standstill and probably are worth no value. The intellectual property that you've developed can probably just wipe out overnight, right? And the sector is a favorite amongst investors. So to be able to have a very friendly investment environment in the country, we cannot afford to have more such instances, right? That because one such instant creates a shadow over future investments on very similar business models and structures that exist, right? So to make sure that we have a friendly investment environment that supports growth, that supports better valuations, more value creation, both from a financial inclusion perspective and from a capital perspective. It's therefore really important to look at governance with an investigative angle at this point of time, because only that can escalate at some day into other personal actions. And that is where I would like to kind of sum up what I have to say.
Sure. Since you just talked about, what could be those measures, I think the question which we have seen from the participants, one of them is on that
Okay.
what role does a partner diligence play in preventing regulatory scrutiny in fintech ecosystems? I think very valid question from that perspective. And you touched upon it earlier as well. So maybe you or Rohan, if you'd like to just quickly answer
I,
that.
I think I think Rohan, if you want to explain that from a governance point of view.
I'm not sure really what a partner would mean, but if it is something like an intermediary who's partnered with you to bring on more business, then it becomes it introduces slightly more risk into your business because you do not have line of sight to the end customer. And that is where I think RBI has also come in with a guideline recently where they are trying to address this risk of intermediaries onboarding customers wherein the financial institution doesn't have the line of sight with the end consumer or the end merchant. And therefore, partner due diligence has to be broken down into two phases. Of course, one is that the moment you onboard the partner, you do the due diligence appropriately, but also you have to have ongoing monitoring, ongoing surveillance around partners' activity to derive assurance that the partner is the trusted one. Ultimately, in financial services, the term that cyber uses, I think I'll use it here, is you have to devise a zero trust system. And the trust has to be, as they say, in God we trust, but for everything else we carry out due diligence. So the ongoing due diligence on the partner is extremely important because they are slightly higher at the risk spectrum, given that they onboard customers in the way that they do, and that's the typical model. And in fact, some of the incentive models that you devise for the partner, as I alluded to earlier as well, can have perverse effect in terms of the way you get businesses because as incentives typically do get gamed at the end of the day. So control around your incentive structure is also very important parameter to look at.
And I'll just add one point there, strictly from the point of view of due diligence, right? And then there are two levels of those. One is knowing your intermediaries and business partners, that's know your business, and the other is know your customer. And especially in consumer-led fintechs, right? Where a consumer could be from the lowest strata of income, transacting at say 5 rupee levels to the highest strata of income who could transact in hundreds of crores at levels in a single transaction, but probably just use services to get payments cleared and reconciled and so on and so forth. At every place, it therefore becomes really important to know where is the money coming from and going and who is it going to, which means and where is it passing through? Are they passing through the right channels and are they compliant with those channels and so on and so forth? Because at every stage, right? We've seen regulators ask these questions. How do you not know who you're doing business with? And how do you not know which customer is withdrawing money from your platform or depositing money on your platform? And irrespective of where RBI places that regulation, I think it is a very onerous responsibility, and I would say it's a very proactive step that I would say any consumer-led fintech must do to make sure that that this sets the highest level of bar in terms of clean money, right? And that's really, I think, one of the most important points today from a regulation perspective.
Right. And I think the second question was actually related to more of microfinance companies, but which are more, they're less sophisticated and also, coming up the value chain, but cash continues to be a good proportion of collection. I think to answer that, I think we would all agree that that requires even more level of diligence in terms of the way all the processes are being run, because the transaction volume, but the systems are not, at the best. But I think the way the government is looking at it, I think it does not give you a choice in terms of, how the processes have to be looked at, is exactly what we already discussed in the session. But any one line you would like to add to just cover those kind of companies as well? Because we are at end of time, so I just be mindful.
Absolutely. I would say whether they're microfinance companies or
Yeah,
whether they are people using digital wallets for the smallest 5 rupee transactions that they do, I think the principle remains almost the same. It is about
right,
what is it that you're doing, like if you apply zero trust, right? It means that you should have the ability and the capability to manage that risk and mitigate that risk of doing business with a person like that. So if you apply that to a microfinance company, and if you deal in extremely high risk customers, that means how are you going to make sure that you're protecting capital in a way that the day you have to repay capital to whoever has invested in your company or lent you money, and how is that probably put that in place, and where does it zoom out to? It zoom out into the risk management policy. It zooms back into the overall governance framework, and that's how all of this is actually one holistic concept, so as to say, just divided into smaller operational aspects, in that sense, right? Also, I'm saying I see a lot of companies now invest more money into financial inclusion in a way that creates the right digital identities and valid identities for its customers, so that they get included into their platform, and the platform becomes more valuable from the point of view of adding customers to other financial products and services elsewhere. So I only see multiples of value getting created out of helping create better digital identities of people who you want to transact with from even from microfinance level. Of course, high risk, but high risk will result into high reward when you have a higher trust in your business.
thanks, and thank you so much for this interactive discussion, all of you. And we are we've already crossed time, but just to thumb up the key themes I can kind of take away from this one, I think clearly GST enforcement in the digital payment network or ecosystem completely has changed. I think systematic data-driven examinations of payout models, commission incomes, reconciliations, often going back multiple financial years, is the way government looks at it. The regulatory message is completely unmistakable. So every intermediary and stakeholder in the payment chain is accountable. Two, I think this discussion also reinforces the risk does not originate only from the tax function. It originated in the operational activities, how projects are structured, partners are engaging, how revenue is classified, and how data is captured and reconciled. I think GST has only become one of the mechanisms where regulator can step in. Third, I think very important factor is that to apply the highest bar on the investigation lens to ensure governance operations and risk frameworks fully, not just adequately, will mitigate any untoward risk towards the organization, its boards, and especially the senior executives. And the most importantly for boards, I think, waiting for a notice is no longer a viable strategy. It's actually the part which you have to play is on a real time, ahead of time, proactively, looking at regulatory alerts, keep, track of things which are happening, the financial operations and personal exposures, interest penalties, all of these things can far exceed the reputation and the tax amounts which are involved in these matters. So proactive action on all of these things with a complete governance is the key. So thank you. With that, I'll close this session. We hope this session gave you some insights, clarity, context to the practical direction and the kind of impact any such investigation can entail. And should you wish to continue this conversation or assess any such, exposures, please feel free to reach out. We had already shared the QR codes. Happy to engage with you. And thank you so much. Have a good rest of your evening. Thank you.
Thank you very much.
Thank you. Thanks, all of you.